I hope today to try and give you a very high-level view of how we kind of think about the world. And in the preliminary discussion we were having before the panel, I was sort of reflecting back, and I've been in this business for nearly 30 years, and every time, every period is uncertain. There's never great certainty, but it seems to me at the moment that we are in an environment where the range of outcomes for economies and markets is probably the widest that I can envisage that being over those 30 years. We have essentially over the last 50 years, essentially a significant build-up in debt in the Western economies and the Western world. That debt is in the process of being unwound, is in the process of being redistributed. And the euro area, which I'm going to make a few remarks on, the euro area is essentially a microcosm, in my view, of the world economy as a whole. It's a kind of case study in the rebalancing that needs to happen. And the benign view would be that rebalancing happens in a kind of civilized and gradual way. And I think the authorities, and certainly in the euro area, have been trying to do that thus far. I think my concern, or concerns I would raise, is that the markets often get to the problem quicker than economists or politicians or whatever get to the problem. And so there is, I think, a risk I'll come on to describe in a minute, that we have a problem that blows up before we can deal with the issues in advance of that problem. So anyway, that's just by way of background. I'm now going to hopefully press the agenda. So what I want to do is to talk about the current environment. I want to think about how, as investors, large investors can try and manage their way, try and protect themselves to a degree in this current very threatening environment, although where there are threats there are often opportunities. So I think it's very easy to get very bearish and get very, very concerned, but I do think that inevitably there are opportunities for investors. I'm also going to make some comments, because I think they are pertinent, about what we would call tail risks or extreme risk hedging. I think too often we think about forecasting, we think about returns as very precise point estimates. And those point estimates aren't point estimates at all. They're very fuzzy disks or circles. And so inevitably there's a huge amount of uncertainty embedded in what we're trying to think about, what we're trying to do. Now, I spend quite a lot of my time making assumptions, or making assumptions for our clients. The most depressing thing for me is that I know those assumptions are going to be wrong, which is quite depressing. So one of the questions I'm always asking myself is, where can we be wrong? How can we be wrong, and can we protect against any of those potential headwinds and potential problems? So I think thinking about scenarios, which is what I'm going to come on to talk about in a moment, is a very important thing to do, particularly in the current environment. So one way we think about the world is to try and think about a sort of central core case of how we view the world, and that's the case there, the case in yellow, which is what we call our base or central scenario. And for some time, our view has been that the world is not going to be recovering from the financial crisis in the typical way that economies do in a normal cyclical recovery. We're not in that situation. Our view has been like that for 5 years or so, and at the start of that period, we felt quite out on a limb. A lot of people now have come to sort of round to that view that the recovery is not a normal cyclical recovery. We think the growth rates in the recovery will be low and mediocre, and we think there will be very large risks around the central path. So we would define that, as I'll come on to look at in a moment, as what we would call a bumpy path to slow recovery. And I'm talking about the global economy. And we've split the world here into the sort of developed world, because I do think we have this mismatch between predominantly the Western developed world and what people call emerging markets. I don't like the term emerging markets. I think it's the wrong term. Goldman Sachs, Jim O'Neill, has coined this phrase, growth markets, which is sort of okay. There'll be a prize for anyone that comes up with the better phrase than emerging markets. But I think there is a very big difference between the two. And what we've seen over the period since what I would call financial crisis 1 is the emerging world actually growing very quickly, the developed world growing very slowly. And you can see here still many of these economies in the emerging world are growing above potential. Inflation has been an issue for them. So our central case, we've attached a 55% probability. Having said I wasn't going to be very precise about numbers, I've now shot myself in the foot by saying 55%, but think of that as a sort of a kind of central view. The negative view is that we see quite significant growth slowing down. That could come from a problem in the euro area, it could come from the US, it could come from China. What kind of bothers me at the moment is there are kind of big risks in all of those three blocks of economies, if you like. So we definitely think the output gap could get wider, combined with lower growth. So I think we've put a 30% scenario on a negative outcome. So overall, we're kind of more negative than we are positive. The positive case, which we always have to think about, in my view, would be probably two of a combination of three things happening. And those three things would be a successful resolution of the problems in the euro area. It would be a successful rebalancing of the Chinese economy from a very high growth export-oriented economy to a more consumption-driven, more consensual, more durable economic growth in China. And the third one would be a resolution of the issues in the US through tax changes, through legislative changes, in order to get the economy growing more quickly. Now, I think my optimism level for all of those three things happening, or indeed even any one of those things happening, actually isn't very, very, very high, and has probably got more negative over the last few weeks than more positive. Although we, again, as I've said, we must try and not always be too negative, but I think it's quite difficult in the current environment to be hugely optimistic. Another way of thinking about the world as we see it, again, this is part of our scenario planning that we do with our clients, or scenario testing, is thinking about probabilities you would attach to these scenarios, thinking about the returns in each of these scenarios, which I haven't done here, but we do parameterize all these scenarios, and then you can attach probabilities to them and stress test portfolios. So it's all very well looking at central cases, but stress testing a portfolio in certain poor and good environments is a very good way to see how portfolios perform, and frankly to see whether you can bear the risk of those portfolios, particularly if you're a pension scheme. So again, this is just another way of looking at that, the scenarios I put on the previous page. And I mentioned in my opening remarks about a rebalancing of the world economy. I do think the economy globally is unbalanced, and we are going through a rebalancing process. Typically, these rebalancing processes take quite some considerable period of time, 5 to 10 year period, if you look back in history. So again, you've got more pessimistic scenarios than optimistic scenarios on here, and again, you can think about sort of elevated or strong world growth as probably being a very low probability relative to some of these other problems. So again, this is just another way of how we think about the world. Just focusing on Europe just for a moment, we get lots of questions on this, and we like to think of the euro situation in, again, 4 different scenarios. Our central scenario is that the authorities will essentially incrementally try and fix the problems as they unfold. So we have a problem, we get some measures, it deals with the problem in the near term, we have another problem, and then we get some more measures, and so on and so forth. And we've had the so-called sort of Big Bang announcement relatively recently, although a lot of the details obviously are still yet to be established. But our current view remains that there will be a gradual but continuing to be a very volatile path through the problems to ultimate resolution. Having said that, I suppose the optimistic scenario would be that there's some kind of grand solution that's actually put in place very quickly. I suspect that that's just, given the nature of the politics involved, is a very low, we'd attach a very low probability to that kind of very benign outcome. The two other scenarios are the pessimistic scenarios. One is, you might argue, well, why am I being pedantic to split between the two? And I think there is a difference actually in these two. There is what I described earlier as an extreme scenario, which is that there's a problem in Europe. It's a banking problem, or there's a major default, and that the authorities are then forced, as we had back in 2008 in the Lehman crisis, the authorities are then forced to take action, and so you then have potentially a very significant downside in markets, so 20% from here, and then possibly quite a strong recovery. The worst scenario, which is the one in red, and I think the probabilities of these two have been going up, is that there is just a general unmanaged unraveling of a problem in Europe, and there's not a particularly or a strong enough policy response, and so ultimately you end up with either countries leaving or euro being reconfigured or some way, shape or form. I think that scenario is really pretty horrible. You end up with a very significant recession in Europe. It's pretty likely to affect the US and pretty likely to affect other economies around the world. So to me, that's a not very attractive outcome whatsoever. I think the probabilities are probably going up slightly of that happening. I just want to say, I just done a couple of words on how we think about risk. I've made the observation earlier about point estimates versus the discs, or a very fuzzy way of thinking about the world. I think we do have to think about the world in kind of regimes, as I would put it. So a neutral or a normal environment where you can potentially rely on correlations and risk and return estimates, and you can model some of this stuff, and then you have to think about what happens in the tails of the distribution. And when you get into the tails of the distribution, different things happen, and you need to be prepared about that. A lot of people think about risk as just volatility or uncertainty. I think one way I would think about risk, or reinterpret risk, is how do events in the portfolios or the balance sheets that you're managing, what impact does that have on your ability to achieve your mission, whatever that might be? So it's really risk around achieving mission rather than just pure volatility. And I think, again, we're evolving the way in which we think about risk into hopefully a more holistic way of risk, rather than just a pure definitional way of thinking about it. And I'll come to pick up the extreme scenario stuff a little bit later on. So that's a kind of bit about the background, a bit about how we view the world. I want to move on now to just talk a little bit about portfolio efficiency, opportunities, and managing portfolios. I'm going to spend most of my time, or the remainder of my time, talking about diversity and diversification. And I think it's important to distinguish between diversity and diversification. And there is a reason why I want to make that distinction. So when we think about diversification, which is the traditional way that investors think about building portfolios of different assets, they're looking at very precise numbers, and they're trying to build portfolios based on those numbers, assuming that the correlations are knowable and that they're less than 1. Okay, they're trying to build diversified portfolios. Diversity is, in my view, is accepting that you don't know what those numbers are, but you want to build portfolios that are robust to different economic and financial environments. So you're using more qualitative approaches rather than using pure optimization, which a lot of people do. The other point I would make is that a lot of people rely on correlations, and correlations being stable. They build correlation matrices. They spend a lot of time thinking about those numbers. We do the same. The problem with those numbers is that they are extremely unstable. They're unstable because you need to think about the drivers of the asset class returns, not just the fact that you've looked at the past returns, looked at the correlation between them and come up with a number. When you look at correlations, they're incredibly unstable. So you have very positive correlations between fixed income or bonds and equities, and very negative periods. So what number do you choose? You have to be very, very careful about how you do that. So that's why I'm slightly careful about using optimization or naive optimization in building portfolios. So I think you have to be very, very careful. So I do think diversity is a really, really important point, and you need to think very carefully about how you build portfolios. Now, when we're building portfolios, we think about different what we would call return drivers. So a lot of people just think about equities and bonds. We've actually broken return for assets down into different drivers, and we ascribe different components of these returns to individual asset classes. So we don't just say equities are driven by the equity risk premium only. We'll break down, depending on how the assets are managed, we'll break assets down into these different, not all assets clearly have all of these components. We'll break assets down into these components and try and build portfolios that are robust to different environments and broadly spread across the different sources of return, again, to manage risk. So if you think about a portfolio, this is just contribution or return driver attribution of a portfolio. Most portfolios, well, most pension fund portfolios that I advise have very high exposure to the equity risk premium. So they are very reliant on growth, okay? They're making a big implicit bet on growth. That's fundamentally been a good call over the last 100 years. But you can get periods where that doesn't work, and you can have 10 or 20-year periods where you're not going to be rewarded for bearing that equity risk. So again, we would think about spreading the allocations across these return drivers. Now, I understand here that there are some new rules, some new regulations that are either being formulated or going to come into effect, which allows much greater diversification across the assets that pension schemes can hold in the Italian market. The two black lines are essentially just showing you, or there's lots of things on this slide which I won't refer to, but just showing you the broad spread and increasing complexity of assets that can be invested in by pension schemes. Now, a number of pension schemes struggle with the complexity this brings because they don't have what I would call the governance to deal with a lot of this complexity. And I understand that's one of the criteria that's being included in the regulations, along with some measure of risk. And I think that seems to me to make perfect sense. Unless you have the governance to understand a lot of these more esoteric asset classes, I think you're going to struggle either with suboptimal implementation or not being able to implement a lot of this stuff at all. So I think as you go out to the right, you're seeing more complexity, more diversity, but more problems in a sense of investing in some of this more complicated stuff. People often talk about the fact that diversification doesn't work very well. They'll say, well, in crises, correlations go to 1. There are two periods here. Unfortunately, the dark blue, the translation of this slide hasn't come out terribly well, because the orange or tangerine strips are actually hiding some quite important bits of information. But essentially, when we look back at the TMT bubble, these are just looking at correlations between these different asset classes. These are correlations to develop global equity. In the TMT bubble, correlations actually didn't shoot up. In the financial crisis, which you might want to think about as a liquidity crisis, a lot of these correlations shot up, but they didn't go to 1. Okay, so I get a lot of questions or allegations saying, well, diversity doesn't work. Diversification and diversity does work. When we looked at if you look back at Q3, a diversified portfolio has actually outperformed a pure equity portfolio by about 5%. So this stuff actually does work. Might not work as well as you might hope it does, but it does. Being diversified is actually better than doing nothing. So the point I was trying to make was what should portfolios look like. So if we think about portfolios and making them more diversified, I'm going to skip this chart and go on to this chart, which is one of the model portfolios that we run. We run 2 model portfolios for our clients. This is the low risk portfolio. It's targeting cash plus 2.5%. It has a lot of, as you can see, it has a lot of stuff in it. So it has bonds, but a whole load of things that were on that diagram with the sloping upward line. Okay, so this is assuming that you have unlimited governance in being able to run a portfolio. So this is, to me, this is what I would call a very complex portfolio. It has a wide diversity of asset classes. It has some tail risk hedges in here. It has some very high quality government bonds. And we're trying here to achieve the return 2.5% over cash in the most optimal way possible. So this is actually a very efficient portfolio. I want to come on now just to make some comments on extreme risks. We've recently issued or reissued a paper on extreme risks. For anyone that wants a copy, then if you give me your card afterwards, I'll email it to you. We wrote this paper in 2007, and we've just updated it. But on this slide, which is a very busy slide, we've tried to think about the extreme risks that investors can face. And in the document that we've produced, it has the severity or the impact of these various extreme risks, the likelihood, and an association matrix. So it's much more comprehensive than this. The other thing we have put on this paper is some of the hedges that you might put in place if you felt that any of these particular scenarios were likely to happen. So some of them have hedges, some of them don't. So a political crisis doesn't have an obvious hedge. A depression, for example, then you probably want to be very long dated nominal bonds, for example. So a number of these have different hedges that you would attach to them, and then you need to think about the weights that you would ascribe to the probabilities around these. But again, if anyone wants a copy, please do let me know afterwards. Just in terms of thinking about hedges and how they can be mitigated, people tend to think about extreme hedges when you've had an event or when you've had a problem. My argument would be that you need to think about tail risk hedging pretty much continuously, and you might want to think about how you would do that when you're in a becalmed or a much more benign environment. It's often the case that you can actually purchase hedges at a much more advantageous rate and at much more advantageous time. I think about hedges falling into essentially 2 camps: either long volatility, that is assets that do well in a high vol environment, so some kind of option strategy, or the flight to quality environment. So if you've got liquidity problems, what things should you hold? So again, you want to think about your portfolios and how they reflect some of these the attributes that I've actually put on this particular slide. The other way of hedging, which I briefly referred to, was using options. Options are often thought by people to be expensive. I'm not sure whether the regulations are going to be allowing derivatives, and I think there is some derivatives allowed for hedging purposes potentially in the new rules. They can be complex, they can be expensive, but they can be very appropriate for certain portfolios. So I wouldn't rule the use of options out. I think they can be very useful. So just to make some brief concluding remarks, I do think that we're in an extremely uncertain environment. I think the range of outcomes is phenomenally wide, which makes asset allocation or making predictions very, very difficult. When you look at valuations of many risky assets actually do look quite attractive. European equities in aggregate, to me, look pretty cheap. The problem is the risk around those, the outcomes is very, very wide. So I think we would view equities in general as being moderately attractive. Bonds, on the other hand, where we've had a fairly positive view up to the last few months, we now think that many bonds have got into the environment where they actually look very expensive. We've had a flight to quality that's going on, which is probably understandable. So investors, I think, are probably still well served by running very diversified and portfolios that have as much diversity in them as possible, rather than betting the ranch, as it were, on a resolution of all these problems. So my final view would be that you probably don't want to be increasing risk at the moment. So thank you for listening. That concludes my remarks. I think we're going to have more speakers now, is that correct?
Assolutamente. Grazie Robert Brown, grazie.
Thank you very much.